In a surprising turn of events, the Federal Reserve has decided to keep interest rates unchanged despite rising inflation and dissent among its members. This decision has immediate consequences for the economy and could change the financial landscape. Let's dive into the details. On July 30th, 2026, the Federal Reserve announced its decision to hold the key interest rate steady, maintaining it in the range of 3.50% to 3.75%. This decision was unveiled during a press conference led by Chairman Kevin Warsh, who emphasized the careful considerations that went into the choice. The meeting, held at the Federal Reserve's headquarters in Washington, D.C., was marked by palpable tension as officials grappled with the implications of persistently high inflation. Notably, 3 Fed officials dissented, advocating for an increase in rates due to inflation rates that remain stubbornly above the Fed's target of 2%. Currently, the Consumer Price Index, CPI, indicates inflation is hovering around 4.5%, a concerning figure that highlights the challenges facing the central bank. The backdrop to this decision includes ongoing supply chain disruptions, which have been exacerbated by geopolitical tensions involving major global economies. These factors have contributed to rising costs for consumers and businesses alike, complicating the Fed's task of balancing growth and inflation control. Historically, the Fed has responded to similar inflationary pressures with aggressive rate hikes. However, the last time it chose to maintain rates in a high inflation environment was back in 2024, a decision that ignited significant debates among economists and policymakers about the effectiveness of such a strategy. The dissenting voices within the committee reflect a growing division regarding the appropriate approach to manage inflation without stifling economic growth. This internal conflict could have profound implications for future monetary policy decisions. As the Fed navigates these turbulent waters, the impact on consumer spending and business investment remains a key concern. Higher interest rates could dampen economic activity, while lower rates may allow inflation to spiral further. Looking ahead, the Fed's ability to strike the right balance will be crucial. As inflationary pressures continue, the central bank faces mounting scrutiny from both sides of the aisle. Investors and analysts will be closely monitoring the Fed's next steps, particularly as they prepare for the upcoming inflation reports and economic indicators. The decisions made in the coming months will play a pivotal role in shaping the economic landscape for the remainder of 2026. The Federal Reserve's decision to maintain interest rates steady signals a pivotal moment for the U.S. economy, with immediate implications for both financial markets and everyday Americans. Interest rates serve as a critical lever for the Fed in managing economic stability, influencing everything from consumer borrowing to business investment. When rates are low, borrowing is more accessible, which can invigorate spending and stimulate economic growth. However, in an environment of rising inflation, as we currently face, the Fed must tread carefully. Inflation has surged, squeezing consumers and increasing the costs of essential goods and services. The latest Consumer Price Index report highlights a staggering 5% increase in food prices over the past year and an 8% rise in energy costs. These escalating expenses disproportionately impact low- and middle-income families, who allocate a significant portion of their budgets to necessities. The housing market is particularly vulnerable. Rising prices for construction materials have delayed projects and inflated costs, making homeownership increasingly elusive for many. Consequently, the rental market is feeling the strain, with prices climbing as demand outpaces supply. Businesses, too, are navigating this complex landscape. Higher borrowing costs could stifle growth and investment, leaving companies hesitant to expand or innovate amid uncertainty about future interest rate movements. Analysts warn that if inflation persists, the Federal Reserve may find itself compelled to raise rates as soon as September, a move that could precipitate a recession. For the average American, this situation is alarming, as inflation affects everything from mortgage rates to credit card interest, directly threatening financial stability and purchasing power. The uneven economic recovery following the pandemic has left many vulnerable, and prolonged high inflation could exacerbate existing inequalities, potentially leading to increased social unrest. Moving forward, the Federal Reserve faces a delicate balancing act. It must rein in inflation without undermining economic growth. The decisions made in the coming months will be crucial for shaping the economic landscape. If inflation remains unchecked, we could witness a tightening of monetary policy that may further challenge consumers and businesses alike. The path ahead will demand careful consideration and strategic action from policymakers to ensure a stable economic future. To understand the Federal Reserve's decision today, we must look back at the events leading up to this moment. Over the past year, inflation rates have soared due to various factors, including persistent supply chain disruptions stemming from geopolitical tensions and the ongoing recovery from the pandemic. In particular, the conflict in the Middle East has exacerbated energy prices, a significant contributor to overall inflation. The rise in oil prices has had a cascading effect on transportation and consumer goods, ultimately impacting household budgets across the nation. Additionally, the Fed's actions over the past 2 years, including multiple rate hikes and quantitative easing, have created a complex and turbulent economic landscape. Previous attempts to control inflation faced criticism, as many argued that the Fed was too aggressive in its approach, leading to increased unemployment rates and slow recovery in sectors like manufacturing and hospitality. The dissenting votes at today's meeting reflect a growing concern among some Fed members that maintaining low rates in the face of rising inflation could lead to a loss of credibility in the long term. Historically, similar situations have often resulted in significant shifts in monetary policy, with long-lasting effects on the economy and public trust. The current inflationary environment is particularly challenging, as many consumers are feeling the pinch, leading to reduced discretionary spending. As prices continue to rise, businesses may face declining demand, which could stifle growth. Looking ahead, the Fed faces a delicate balancing act. Policymakers must weigh the risks of curbing inflation against the need for sustainable economic growth. The decisions made in the upcoming months will be crucial in determining whether the Fed can stabilize inflation without derailing the recovery, especially as midterm elections approach, further complicating the economic landscape. Looking ahead, the Federal Reserve's recent decision presents us with several potential scenarios that could shape the U.S. economy in the coming months. The Fed's actions are rooted in a broader context of rising inflation, with prices climbing at their fastest pace in decades. This inflationary pressure has been driven by a combination of supply chain disruptions, increased consumer demand, and rising energy costs. One possibility is that inflation continues its upward trajectory, prompting the Fed to raise interest rates by September. Such a move could cool off spending and investment, leading to a slowdown in economic growth that may push the nation toward a recession. Historically, rapid rate hikes have often led to downturns, as borrowing costs rise and consumer confidence wanes. Conversely, if inflation stabilizes, the Federal Reserve may choose to hold its current position, allowing for a gradual, albeit sluggish, economic recovery. This scenario would likely foster a more stable environment for consumers and businesses, but growth could remain tepid, hampering job creation and wage growth. Experts are sharply divided on the implications of the Fed's recent actions, with some warning of a precarious balancing act as the central bank strives to control inflation without stifling growth. The impact on financial markets could be significant, with investors reacting to shifts in economic indicators such as consumer spending, job reports, and inflation metrics. A sustained rise in prices could erode purchasing power, creating public dissatisfaction and political pressure on the Fed. As we look ahead, it is crucial to monitor how the Fed's decisions influence consumer behavior and business investments. The coming weeks will be pivotal in determining whether the Fed can effectively navigate these challenges or if it will inadvertently trigger a cycle of inflation that spirals out of control, impacting millions of Americans. As we ponder the Fed's future moves, what do you predict will happen next? Share your thoughts in the comments and subscribe for daily deep dives into the biggest news stories.